L&T just delivered their Q1 report card. The management is addressing the media right now. Let's take it across to them.
Of Competition Commission of India for divestment of electrical business. And that's a big formal step that has been crossed for us to work towards consummation of the transaction. So according to the accounting standards, any such business which is held for sale needs to be disclosed as discontinued business, and the results of the business will be just reflected as a single line item as profits from discontinued operations, and it will not have any other presence in the financial statements in terms of revenues, costs, etc. So the numbers that we will be presenting to you are excluding at all levels other than PAT the operations of electrical business. Secondly, this quarter also saw us complete the open offer for Mindtree, and we completed the process, and we have today owners of 60.6% shares of Mindtree. So that's another significant event that happened in the quarter. And the third event is for our L&T Technology Services, a listed company in the space of engineering services. We had to achieve the targeted minimum public shareholding of 25% 3 years from listing, and the 3 years were coming to an end later this year. So we, during the quarter ended June, completed the divestments to reach that 25% public holding threshold. So all three things were significant events, and we have completed. While doing all of this, we also managed to pay attention to our business, the engineering construction business, the projects business, manufacturing and services business, about which we will possibly see. Before we get into the results, I think the usual disclaimer about forward-looking statements that will be made in the course of the presentation and the conversation that follows the presentation. In terms of highlights, it's been one of the very stable quarters. We performed well and to plan on most of the parameters that we set ourselves for measuring the performance of the company. The orders, the fresh orders that we took increased by 11%. All of these are in comparison to quarter one of the previous year. The order book consequently rose by 9%. We are almost closing in on 3 lakh crore of order book. Revenues increased by 10%. EBITDA increased by 20%, which is good news because I think profitable growth is always important. So the revenue is growing by 10%, EBITDA growing by 20% is good signs. And consequently, the profit after tax has moved up by 21% year-on-year comparison for the first quarter. Starting from order inflow, during the quarter ended 30th June 2019, the company won orders worth 387 billion rupees, which is 11% growth over the 348 billion that we recorded as order wins during quarter one of the previous year. As you can see, 23% of the orders that we have won during quarter one came from international markets. And in comparison, year-on-year basis, the domestic orders that we won during quarter one of the previous year was 257 billion. We actually, during the course of the current year, first quarter, we won orders worth 297 billion rupees, which is a 15% growth on the domestic markets. The international markets have been flat, 91 billion rupees of the quarter one of the previous year, by and large remains a similar level during the quarter one of the current year. There have been some orders which have been deferred for award, which were actually targeted for quarter one, and they didn't come through, and we hope that they do materialize in quarter two or thereabouts. As far as domestic orders are concerned, the growth, actually we are quite surprised that we could ramp up on domestic orders, because this, as you know, was an election quarter. So we weren't very sure about the disruption that the electioneering process would set in terms of winning orders. But fortunately for us, I think the momentum that we carried in from the previous year, particularly the fourth quarter into the current quarter, enabled us to keep winning the orders, and credit to the agencies which gave these orders that they continued to persist with ordering out and moving forward on the programs. We won a large power EPC order after a long while, and very sweetly beat BHEL to get the order, and it helped along with some hydrocarbon orders from ONGC, it helped us clock better domestic order wins during the current quarter. The order book, as we see now, is 2.9 trillion rupees, which is a 9% growth over the 2.68 trillion that we were at June of 18. 62,000 crores worth of orders are from international markets, and they represent around 21% of the total order book. Much of the orders, as has been the pattern over the last few years, have come in from infrastructure segment. Of the 387 billion rupees worth of orders that we won, 45% came from infrastructure segment. Consequent to the order win in the power group, the contribution of power EPC for the order inflow increased to 17%. Hydrocarbon was at 8.9% based on the order wins of 3,500 crores during the quarter. We normally, for the purpose of statistics, since we are presenting the consolidated financials, do include the services income as order inflow, just to balance the math, and the services contribute to nearly 22% of the total order inflow. When it comes to order book composition, 75% of the order book is in the area of infrastructure. Out of the 2.9 trillion rupees, 2.18 trillion rupees are in infrastructure segment that will be executed over the next 3 to 4 years' time from now. Hydrocarbon has moved to 404 billion rupees, which is another large piece of order book that we are required to execute over the next couple of years. Power at 129 billion rupees and defense at 110 billion rupees constitute other significant portions of the order book that we have as of 30th June 2019. When it comes to financial performance, the revenue of the company for the quarter one under reporting is 296 billion rupees, which is 10% growth over the 270 billion rupees of the previous year. 31% of the revenues that the company has earned during the quarter comes from international orders, both exports as well as project orders. The manufacturing construction expenditure incurred by the company at 179 billion rupees for the quarter is up 9%. And the interest cost of the financial services business, which is regarded as an operating expenditure on par with the manufacturing, construction and core costs of bringing the revenue, is at 20 billion rupees, which is a 26% growth over the previous year's corresponding quarter. Staff cost is at 45 billion rupees is up 10%. There's been staff augmentation in the services business, information technology business, engineering services business, as well as financial services business have increased the headcount, and over the period of last 1 year have added people. And particularly in the information technology and engineering services business, people are added on-site locally in the overseas markets, and hence they do contribute significantly to the cost escalation. And we do hope that those hires will help us churn out better revenues and better profits in the subsequent quarters. Sales and administration expenses at 17.5 billion rupees is down 12%. This is largely on account of lack of requirement to make any provisions for ECL and other purposes during the quarter as compared to the corresponding quarter of the previous year. Hence, the total operating expenditure as against the revenue of 296 billion rupees comes to about 263 billion rupees for the quarter. EBITDA consequently at 33 billion rupees is up 20%, and the EBITDA margin moves up by 100 basis points from 10.2% of the first quarter of the previous year to 11.2% of the current year. Other income at 3.8 billion rupees is up 69%. We were able to take advantage of the fact that the surpluses that the businesses collectively had as a group were deployed profitably in markets, in safe instruments, and hence they were able to generate a yield which gave the benefit of the other income. Interest cost at 5.9 billion rupees is up 61%, largely on account of the additional borrowing that the group did across its various businesses, largely as a result of liquidity buffer created to enable completion of transaction like Mindtree and potentially a buyback as and when the regulators would deem fit. Depreciation amortization at 4.6 billion rupees is lower as compared to the previous year, largely because the previous year had certain amortization which is no more required to be made in the current year. The exceptional item at 0.9 billion rupees is largely on account of impairment of equity investment in a road project as a part of IDPL portfolio. And there has been an admission by NCLT for insolvency proceedings of this road project, where we are not the majority holders, the banks are majority holders. The banks have moved the NCLT, and consequently, in recognition of that development, we have impaired the equity investments that we had more in terms of prudent accounting. The outcome of NCLT proceedings to know in due course, but not wanting to wait for the outcome, we thought it is important that we recognize that this investment is impaired. But they are part of the exceptional item that we have. The discontinued operations represent the electrical business, the net profits earned by the business at 1.1 billion rupees as compared to 0.9 of the previous year. The business overall has done well. The revenues have grown by 6% and its margins have improved, and hence the profitability improvement of 31%. We will cover a bit of that in the subsequent segment section of this presentation. The reported profit after tax for the quarter for the group as a whole is 14.7 billion rupees, which is up 21% as compared to the 12.1 billion of the first quarter of the previous year. The segments are by and large the same, except that the electrical and automation segment, which is part of the core operating segment, will be moved to discontinued operations segment. So consequently, in the pecking order, they would come in last. Starting with infrastructure segment, the segment earned a revenue of 138 billion rupees, which is 14.3% higher than the 121 billion of the previous year. Based on the large order intake of the previous year, the segment has done well to move ahead on its execution plans. Out of the 138 billion rupees of revenue, international revenue are at 32 billion rupees, which is down by 14% as compared to the previous year, largely on account of closeout of several large international projects that the company has been executing over the last few years. The EBITDA margin at 6.4% statistically is 49 basis points lower than the corresponding period of the previous year, but this largely reflects the stage of execution of much of the orders that we have picked up during the later part of the last year, and consequently does not reflect the actual margins from the infrastructure segment going forward for the year. Power segment, the net revenue of the power segment is 5.6 billion rupees, almost down 50% as compared to the previous year, largely on account of depleting order book. During the last 1.5-2 years, we've been speaking about lack of orders for the power segment. Consequently, as the order book got executed and we were coming to the fag end of those projects, the revenues, as expected, were declining. Now that we have picked up a significant order during the current quarter, we do expect slowly over the subsequent quarters, maybe over the third, fourth quarter, the revenues will start picking up. And we do hope, looking at the pipeline of orders that are likely to come out from the segment, there could be an opportunity for us to participate in a couple of more bids, and let's see what the outcome has for us. Much of the international jobs that the power group was doing is in Bangladesh, and many of those jobs are coming to an end, and that's reflected by the income coming down from 3.5 billion of the previous year to 1.6 billion in the current year first quarter. The EBITDA margin at 3.3% again is reflective of the mix of the job and the stage of their execution, and hence statistically there is a 80 basis points reduction in this quarter as compared to the previous quarter. As the order intake increases and the execution picks up, these margins are expected to get back to more normal levels. Heavy engineering business had benefit of significant order wins in the previous year. Consequently, the segment is reporting one of the highest quarterly earnings at 8.7 billion rupees, which is 162% higher than the 3.3 billion of the first quarter earnings of the previous year. Much of that business is also meant for international markets, as you can see from the share of international revenue. 3.8 billion out of 8.7 is on account of international orders that we have won, and that is also growing on par with the overall income of the segment. The margins are reported at 19.5% for the quarter as compared to 36.1 of the previous year's first quarter. In the previous year's first quarter, there were several jobs which were come to an end, where all the cost provisions that were no longer required were released into the accounting statements. Consequently, there is a elevated margin of 36.1%. And this happens whenever there is bunch of jobs which get completed. These kind of unused cost contingencies get released. So to an extent, they don't represent the normal linear trend of margins. But notwithstanding that, margin at 19.5% is fairly healthy for a business where we have some unique capabilities, even on a global scale. Defense engineering segment, there's been growth in the revenue at 9.7 billion rupees, is up nearly 33% as compared to 7.3 of the previous year. Here again, there has been a bit of an international orders that we have won, largely on account of naval orders, which is at 0.4 billion as compared to 0.8 of the previous year. The EBITDA margin at 16.5%. It's a combination of improved efficiency in the defense and aerospace business that we run, and the job mix that is yielding these margins. The shipyard has not contributed significantly to these margins because they are still underwater in terms of ability to recover, and we're still waiting for the government to place significant orders that justify the investment of the top class yard that we have built. Hydrocarbon segment continues to have good run. We had revenue at 37 billion rupees for the quarter, which is 7.2% higher than the 35 billion of the previous year. Much of this, in fact, half of the revenue goes to international markets from orders that we win from there. So 18.5 billion is revenues from international market, pretty much at the same level as in the previous year. The margins have improved by 60 basis points from 7% to 7.6%. And the business is in good shape because the projects that we are currently executing are on schedule and are generating profits. And we also see a healthy pipeline of fresh orders in the Middle East and African markets. And the company will look at each of these on its merit and decide on participation. But the business is on sound footing. Information technology and technology services, these are two different companies listed, and you would have seen the results, but for a purpose of consolidated results, we segment them together and they form the IT and TS segment. The combined revenue of both the companies, L&T Infotech as well as L&T Technology Services, had to 38.2 billion rupees, which is 15% growth over the 33 billion rupees of the previous year. Much of this revenue comes naturally from international markets. US, Europe are large markets where these businesses participate. So 34.8 billion out of 38.2 billion is from international markets. The EBITDA at 23.2% is 1.5% lower. And in this quarter, we had both the impact of local hiring as well as visa costs getting absorbed into the costs of the company. And hence, we see a decline in the margin. We do believe that with subsequent quarters, we should be able to get back to the original levels of margin, which is...
Well, that's the management of L&T addressing the media, talking about the contours of their Q1 report card and what lies ahead. They've also talked about the fact that the company now owns 60.6% of Mindtree. International markets have been flat, certain orders have been deferred, so they're talking about the outlook ahead as well.